Investors Chronicle.
Welcome to the Companies and Markets Show. It's Thursday, the 4th of January, as we record. It's the first show of 2024. Today, we're going to start, therefore, with a bit of New Year cheer, courtesy of Next's seasonal trading update released this morning. This week also marks 40 years since the launch of the FTSE 100, which has been the cue for plenty of rather more doomy headlines. We'll examine whether that analysis is entirely accurate and consider prospects for the year ahead. And our cover story this week is our annual Ideas of the Year feature, so we're going to touch on those briefly to wrap things up. Joining me to discuss all this are, over the line, Julian Hoffman.
Hi, Dan.
And in the studio, Mark Robinson.
How's it going, Dan?
Very well, thank you, Mark. And Alex Newman.
Hey, Dan.
Hi, everyone. Happy New Year to you all. Mark, we're going to start with you. We're going to start with Next. It's early January update. It always tends to be a beacon of light, certainly for stock market observers who are starved for early year news flow. This time, as has been the case for the company's past few trading updates, the news itself was pretty good as well.
Yeah, without a doubt. But I don't think we can read too much into this latest update from Next. It's something of an outlier. It has been in the past within the retail sector. But certainly shareholders would have been pleased. And it wouldn't have really surprised retail analysts, though, because the stock continues to outperform and deliver on its previous guidance levels as well. I think we can't read too much into it. There's going to be a flurry of retail updates in the coming days too, which will give a little bit of a better indication about how the sector itself is going.
Yeah, you're bringing us straight down to earth there, which is fair enough. I mean, today, as we may come to, we do have also a profit warning from JD Sports, so clearly there's some disparity out there. But as you allude to, this is I think the fifth time in a row that they've raised profit forecasts. What do the figures actually say about how trading has been over the Christmas period, and also how they expect the year to go?
Well, in the last few weeks of the final quarter, I think overall sales might have been up by about 5.6%, but it wasn't split evenly across the different sections of the business. The online category was the outstanding performer. That was up ahead by about 9.1%, whereas retail was not exactly flat, but it was a sort of a relatively modest increase by comparison. It's always sort of interested me really that Next is doing as well as it has online. Well, perhaps not the fact that it's done that well online. It always seemed odd to me that it was a late comer to that section of the retail sector, given that it was previously largely a catalogue sales business when it first started, along with its obviously high street outlet. So you would have thought that it would have been able to sort of transition. I guess, again, you could say that it points to a certain level of circumspection on the part of management, because down through the years, it's actually the company's become synonymous with prudent management decisions as well, and that's part of the reason why it has consistently outperformed the sector as a whole. It's extraordinary, really, because I mean, people have been waiting. It hasn't been sort of linear progression, but people have been expecting it to slip up badly year after year, and yet here we are. Goodness knows how many years down the track, and the company's still going strong.
Yeah, that's definitely the case, and you can see that reflected in the share price over the past year, can't you? Up, almost 40% now, not least on the back of those 5 profit upgrades in the past 10 months. Alex, maybe I'll just bring you in early on here on Next. What are your thoughts on the company's trading prospects at the moment and general prospects?
I think it's key for when you're looking at any retail brand to think about the consumer that they're going after. And with Next, they've cultivated a consumer that is just, I don't know, it seems a lot easier to respond to or forecast against than lots of the other retailers. Added to that, the point that Mark makes is totally valid. They are a brilliantly managed business. I mean, it probably helps that Simon Wolfson now the longest serving CEO in the FTSE 100, has been at the helm for almost 23 years. You know, if you're an investor, you just have to love their guidance. I mean, they're really transparent, detailed on every part of the financial accounts, sort of meticulous in explaining ahead of time what they can and cannot control. I think in terms of their immediate prospects, I mean, it's always going to be incremental with Next, but incremental can be a great investment because, you know, you do take care of the small things, stay plugged in with your customer, your core consumer base, and you can, you know, keep rolling that over and compounding it into to excellent returns. I suppose looking ahead, today they've disclosed, as they often do, their balance of risk and opportunity factors. On balance, it's probably reassuring, I think. I mean, they say that one of the good things about Next is the way they source their product, and their stable or falling factory gate prices at the same time as, you know, wages moving ahead of inflation is probably a good dynamic for them. It's something that clothes shoppers, you know, really notice and respond to if they feel a bit more in their pocket, and yet prices aren't rising. At the same time, offsetting that slightly, you've got these macro headwinds they can't fully control. You know, one of them they highlighted is the shape of uncertainty around the Suez Canal and what that's going to mean for international shipping, which I imagine is something we're going to talk about a lot in 2024, and possibly weakening employment and rising mortgage costs. On balance, though, you know, it's a fairly confident note I think they struck today. The other point Mark made, really, really important as well. This is not necessarily a reflection of the broader retail environment. They're just really plugged into this, you know, this Next shopper, and things for Next shopper look, you know, reasonably good.
Yeah, I think another point worth mentioning as well, and it points again to the prudential approach taken by management, is that they've gone into the end of season sale with surplus stock down by 12%, which would suggest, when you combine that with the fact that they had that increase in full price sales too, it does point to a certain degree of caution on the part of management. But, you know, these type of companies live and die by the way that they manage their stock levels, because obviously, you know, you've got so much capital locked in there, and if you end up selling that at a discounted rate, I mean, you're going to end up heading in the wrong direction. And this is a key feature of the Next business model down through the years, is the fact that they've kept such a tight grip on inventory.
And that's the flip side of that is really reflected today in the JD Sports update, isn't it? Where they say promotional activity has been higher than expected. They also mention the poor weather, or the weather that was different from what they may have expected, which is a recurring theme nowadays as well for a lot of retailers who aren't Next. But that promotional side of things, you know, having to discount more has really hit them, and therefore really hit the shares today. So you can see the opposite effect there.
Yeah, I mean, you'll see that in the coming days and weeks, really. The retailers that have actually been forced into that situation, and it does come down to sort of inventory management as well. The fact that they have to somehow turn that capital, or liquidate that capital in a sense. JD Sports haven't managed. I didn't quite understand that reference to the weather as well, because surely that would, winter sales, that would refer to sort of knitwear and coats, which isn't exactly their bag. I mean, don't get me wrong, I haven't been into one of their stores in quite some time, but you would think that would have more of an impact on a company like Next, because it's more utilitarian in a sense. You know, it's workwear to a certain degree, but it hasn't played out, and I don't know. It sounded a little bit desperate to me.
Well, I suppose in their defence, or, you know, I'm just thinking off the cuff here. You know, yeah, this is about their clothing line, the weather reference, rather than the trainers side, and you know, they are an outdoor brand as well. So if you're getting slightly warmer weather, I suppose the sale of North Face jackets that everyone seems to own nowadays is probably going to struggle a bit. So maybe there's something like that. In fact,
Yeah,
Mark, you're wearing a North Face.
I am, but
yourself.
But I haven't actually been into their where's their flagship store in Oxford Street. I'm of the wrong sort of age dynamic, really, to be commenting on JD Sports.
True. You know, just to go back to what Alex was saying just now, it was quite a good summary, I suppose, of the positives and negatives facing the UK consumer this year. On the one hand, you know, wage growth is starting to overtake inflation, if it hasn't done so already. On the other hand, for companies like Next in particular, mortgage costs and remortgage costs being higher are going to have an impact this year. If you're a renter, for a focus on different retailers, those costs are still rising as well. So it's quite hard to discern how these things will balance each other out. I have seen this morning some quite optimistic forecasts for UK inflation, I think from Goldman Sachs, saying it'll be below target in the first quarter, which is pretty, even as we sit here in January, would be a pretty good and pretty swift development from that stage. Can we sum these things up? How do we see the outlook for the consumer? Last year was very much a story of the consumer doing better than expected.
Yeah.
Consumer spending holding up. Can that continue?
Well, by and large, I think that changed as the year progressed, and it may well be the fact that so many mortgagees are going on to a variable rate in the early part of this year, and just the expectation in itself is enough to constrain household budgets and discretionary income. So, I think the point that Next management has made is valid enough. But then again, you look at it and it seems that at the coalface, borrowing or mortgaging costs are actually falling now. And you wouldn't expect that the base rate would go any higher than where it is at the moment. So perhaps that's a positive in terms of overall consumer sentiment. I think it's... I think we'll have to wait well into the second quarter before we see if this has had any sort of material impact going forward. It's a bit of a cop-out on my part, of course, but there are so many variables at this stage.
Well, we will also have a few more retailer updates in the next few days, as you allude indications as well. And it's not just Next that has done well, we should say. It was in the dark days of December, but Currys had a pretty good trading update back then as well. So, obviously a different part of the retail sector, but there are still positive signs on consumer spending resilience. So we'll keep tabs on how they develop. For now, though, we are going to turn to the FTSE 100 in sum, because this week, yesterday to be precise, Wednesday, as we record today, Thursday, was the 40th anniversary of the index's inception. As I said, that did spark various rather dismal analyses talking about the FTSE reaching middle age, the FTSE being over the hill, which, if you, like me, are also turning 40 this year, were extremely depressing to read. But are these entirely accurate? We'll get to that in a minute. Maybe we can first of all look at the performance post-mortem, if you will, because a lot of the reason for the gloom and doom has been looking at its performance relative to the S&P 500 over the past few years. And clearly it's lagged quite a lot over 10 years, 20 years, since 2008 in particular. Julian, maybe I'm going to start with you, bring you in. You've been on the sidelines so far. What's your take on the entire history of the FTSE, but also, its relative performance to the US? Are these kind of comments we've seen this week justified in as far as that performance is concerned in and of itself?
Well, I'm often reminded of Karl Marx in these situations, who said that history repeats itself first as tragedy and then as farce. But leaving that aside, the FTSE has provoked quite a lot of, wire-wying over the last 5 to 10 years, probably. But what tends to get overlooked is that the index, until 2010, actually performed pretty much in line with America. It's America that has accelerated away from the FTSE 100 in terms of performance. If you stuck your money in a tracker in 2009 in the S&P 500, you've got 500% return, and the FTSE over the same period has only doubled in value. That's excluding dividends. So it's a very unfortunate series of coincidence, really, that has happened, and that's coincided with the fact that 5 or 6 shares on the US market are powering that return. And the UK market, by contrast, is led by mature companies that do relatively boring things but vital, who earn a lot of their money in dollars overseas, who will perform year in, year out, and will pay the dividends. And you're just in this situation at the moment where investors will dump, BP at 5 times earnings to buy Amazon at 85 times. So there's a certain amount of sense that it's not all the fault of the index or the underlying economy, that there are factors that are simply beyond the control that nobody would have foreseen in the 40th anniversary, that it was quite this extreme in terms of performance. But no, I mean, I'm with you on that. I turned 40 a few years ago, and I don't know. I still feel like there's plenty of life in me left.
I actually entered the equities industry in 1984 as well. So again, that's another interesting anniversary. On a point you alluded to there as well, Julian, is that I got some data through this week from AJ Bell, and they'd bothered to look at the total return, including dividends of the FTSE 100. And of course, UK benchmark index stocks pay a much higher proportion or return a much higher proportion of their shareholder funds than the US firms. And when you take that into consideration, it narrows appreciably over time, although in the last 10 years with the Magnificent Seven, or I can't remember their early incarnation, the US market has sort of pulled away. But when you look at it from a total return basis, the FTSE has actually outperformed many other overseas indices over that time as well. It's just the fact that it's an inevitable consequence of, as you say, it's full of mature industries, commodity companies, large proportion of financials in this. But if you take the income argument with it as well, the performance itself actually has been quite credible over that period, and we saw the value. We saw the value of the index highlighted during 2022, when a lot of capital rotated out of growth stocks and into value, and then the index showed its worth during that period. So I think the negative comment that we see in the press, or perpetually in the press, is rather overstated.
Alex, what are your thoughts to that end?
I agree. Part of the post-mortem that this 40th birthday is invited, I think, as you allude to, rather than it just being another arbitrary landmark, is that is the comparison with the runaway market of choice, or of comparison, which is the S&P 500. So prescribing more technology stocks, or that the FTSE 100 should just look more like the S&P 500 and attract those businesses, is very easy to say. In practice, that's a multi-decade shift which needs to happen, and requires lots of incentives and things that are difficult to ask of any index or country. So we kind of have to ask what the FTSE 100 is for, and sort of acknowledging that it's not going to turn into a sort of Magnificent Seven sort of technology whiz story overnight. But people do understand its idiosyncrasies and failings to a degree. There is not the renewal which you would like to see in any market, and that is really important. That does have to be addressed over time, when you're looking over the next 40 years. But if you want, your portfolio to do certain things, the FTSE 100 can, as Mark alluded to, see 2022 for further evidence, can achieve that. It can act as a hedge in times of interest rate, geopolitical or inflationary strife, just because of the composition of its constituents. So just saying we need to be, or it needs to be more like the S&P 500 to try and match those returns, is maybe sort of misdiagnosing what it can be, or what it is possible that the FTSE 100 can be. And also, the reality that every investor should understand now, that you can pick and choose. You can and probably should have a good portion of your equity portfolio in global equities. But, the FTSE 100 can still serve a function within that doesn't have to be relegated to the 4% or whatever it is now in a MSCI World index-weighted terms. So yeah, let's not write it off just because, the last decade has seemed like a particularly poor time compared with the S&P.
There has been that pull away as well from domestic pension funds too, which has been much in the news of late. And if we go back to the Gordon Brown's tax reforms as well, that may have had the effect over the long run of pulling volume out of that market as well, which is not supportive for share price valuations. Some of that is due to the fact that it's become a much more globalized equities market. Then it was much easier for funds and certainly individuals now than it was 20 years ago to hold overseas stocks. But at the time of Gordon Brown's reforms on that basis and the effect that it had on pension funds, some analysis pointed to the fact that it would take about 20 years before all the ill effects to come through, and we might be seeing this now. So any incoming government, if they wanted to support the stock market and try and reinvigorate the LSE in the coming years, might have a rethink on that score.
The other thing I wanted to highlight, just in the performance terms, is that in the past couple of years, things haven't maybe been as bad as people think either. We spoke about the good 2022, and that can really carry the FTSE a long way, even in this comparison with the US. Because if you look at, say, I had a look at performance of the two indices since March last year, when the Fed started hiking rates, and also since November 2020, which was when you got the news about the vaccines for coronavirus, and so the start of this whole kind of new paradigm, as it were, almost. So in both those situations, the FTSE is very nearly, and until recently, it was ahead of the S&P over both those timelines. It's only the sort of the fierce rally of the past couple of months that has put the S&P ahead again. And so if you consider, all these timeframes are arbitrary, be they 3 years, 5 years, what have you, but you consider those changes in market dynamics, i.e. higher rates, but also before that higher inflation, and the FTSE has done very well, albeit over a short period of time. And it's ultimately all about the compounding, as we say, and the dividend aspect for the FTSE is very important to that total return. I'm gonna challenge you all with a quick quiz question now, though. How many companies are still in the FTSE 100 that were there in 1984? Obviously, you can define this in slightly different ways depending on name changes and what have you, but there's a figure or a couple of figures.
11?
I have in mind 11. Alex, what's your thoughts?
A little higher, maybe 20.
Julian?
Yeah, I'd go around 12 or 13. Let's say 13.
Well, the answer, as I say, there are two answers. One, FT Alphaville today or last night suggested 29. PL Hunt suggests 33. So a full third of the index is still there. Yeah.
Well, I was only halfway there.
Yeah, close enough. I mean, again, a lot of these have been renamed, but there you go. There is certainly some, or acquired other companies, but there is a persistence there. Let's talk about the year ahead and some of the catalysts for change. We've talked about rate cuts. We alluded to, the general outlook for the UK economy. What about earnings outlooks? Julian, I think you've been looking at UK earnings outlooks in general. What are the prospects there?
There's an interesting series of research coming out recently about how corporate earnings will behave this year as we go through. And what's coming out of that is that the picture is generally on the positive side. But what could be interesting is how mid and small caps perform this year, which if people sort of cast their minds back over 2023, the worst affected parts of the market were the sort of mid small cap and AIM shares, and mainly because those companies are heavily dependent on the UK economy itself, and they weren't able to pass on price rises, or they had to take significant cost rises themselves during that inflationary period. And unlike FTSE 100 companies, they're not able to use their market power to offset that. So 2023 was a relatively bad year if you were a small to mid-cap player. But research now suggests that could be on a bounce back level, and that's obviously linked to how inflation performs. But some people are suggesting that corporate earnings at that level should go up by about 20 to 22%, which would be an amazing performance, you have to say. But so it's like the outlook is generally positive, but it's going to depend a lot on how the British market economy and consumer behaves next year. And if that is positive as we go through the years, as there seems to be a lot of suggestion now, then the smaller part of the smaller half of the market is going to benefit because they will get the throughput from lower prices, which will help their profitability. So yes, there was an interesting. It's an interesting game of two halves, as it were. So we're basically on a bounce back trend, I think, as far as we can tell.
A salutary reminder, I think, as well, that of course it's not just the UK versus US, but to some extent there's intra-UK dynamics as well. As you say, last year particularly bad for small and mid caps, and the year before, and we have been looking for that kind of rebound for a while now. So perhaps some stars are aligning. We will all hope so, at least.
Could be a dual election year.
Well, that is likely to be the case, isn't it? US, probably UK. So we'll see what happens there. Another, we're not going to do a whistle-stop tour of the entire world, but Europe is another region which, Julian, I know is close to your heart sometimes in terms of European equities. And there was one piece of corporate activity you wanted to touch on.
Yeah, as we know, Europe seems to be on a slightly better trend line than we are at the moment. But European banking has been in the doghouse for years, and for very good reason. But the recent news that's been quite interesting is that the activist investor Cevian, which is the sort of Swedish-based intervention fund, they've bought about 1.3% of UBS, the one-time near-failed Swiss bank, but subsequently the owner of large parts of Credit Suisse's wealth business. And I thought that this highlighted some interesting expectations, really, on how investors expect things to unfold, because the reason why Cevian has bought such a large chunk of UBS, I think it's about it's like 9% of their total fund has been invested in those shares. They expect wealth management particularly to continue. And the question that immediately forms in my mind, and also in the mind of some analysts, is whether that is going to be the case as we go through the year. And the services that banks could offer very rich people at a time of low interest rates were sort of vital in keeping your wealth turning over. But as rates normalize, the question is whether that trend can continue in that form, or whether we're really sort of at a turning point when it comes to wealth management. I mean, wealth management has been the growth sector for most financial services firms over the past 5 to 10 years. And the Cevian buy sort of assumes that will continue, but it's a very, I would say, quite a binary situation. So I thought I'd highlight that. That's an interesting take on where they see growth coming in Europe, but I think it's open to interpretation.
To me, it seems slightly late as well. I remember when we discussed on this show the teeth of the mini banking crisis last March. When they first took over Credit Suisse, their shares were down, I think, 10% on the morning, which seemed crazy to a few of us, given the dominant market position they just secured in Switzerland, and presumably relatively free of competition concerns, given they've been bounced into it as well. Since then, the shares have done very well, but perhaps that is the key aspect of the rationale with wealth management as well, in that they have a large chunk of the Swiss wealth management market now entirely sewn up. There is not one big competitor anymore. There are a lot of smaller private banks and a few mid-sized ones, aren't there? But that big competitor is gone forever, it seems.
It also seems ripe for challenge if you want to look at it from that point of view. That you could see a situation where there are more boutique managers that come along and offer bespoke services, and banking has proved conclusively over many years that size and capacity aren't necessarily the main qualities that do well for investors. So it's we will see how it plays out. But Cevian is generally quite a canny investor. So I mean, whether they force UBS to restructure the business comprehensively, one suggestion is they might move it lock stock to a US market listing in order to increase the value. which is something that they did with CRH, I remember. They do have options on the table, but I'm not sure that the base case that wealth management, now that interest rates are higher, is going to be a growth business is secure, really.
That's a fair point. We're going to conclude, because we are running short on time, with a very brief look at our cover feature this week, which is the big Ideas of the Year issue, the Ideas of the Year for 2024, when we take a look at various sectors of the UK market and beyond. Alex, you've overseen this big project as usual. We're not going to go into specifics, but can we talk about the ways we group the companies for this feature?
Yeah, readers who are familiar with this long-term feature and will have saw last year's one will know that we have for the last few years been grouping our ideas into sort of baskets or mini portfolios that kind of encapsulate a theme that we think is likely to do well or is worth highlighting or could be a source of good ideas for the next year. So those buckets haven't changed radically from last year. I can sort of just list them in turn and sort of explain the value for slightly modifying or clinging onto them in each case. So we have global giants, which is very similar to one we had last year. Very conscious of the astronomical values that some of the star shares, particularly in the US, reached last year. Notwithstanding, we have included a couple of them in our basket for the simple reason that you cannot ignore some of these companies, and in both cases, we think there are the potential is still astronomical there. So that kind of explains why we think investors always need to think about the some of the largest global stocks, regardless of how things have run up in the last few years, because there are still real opportunities there. There's a couple of portfolios. We've got the even more small cap value stocks and a similar play on that, which is special situations, both of which are focused primarily on UK value, where at the junior end of the market there's some just astonishingly cheap stocks out there, and the raft of takeovers which we saw in the final quarter of 2023 I think is an indicator that being selective here and looking at good businesses with sound prospects can help you nonetheless find shares which are materially undervalued on sort of almost any measure. The final two is UK quality stocks, which did actually had a really good year last year, bouncing back after quite a beat down in 2022. I think there's a little bit of a share price appreciation and valuations we've seen in some of those stocks, but it's a reminder that there are quality businesses in the in the FTSE 100, FTSE 250, despite the associations that the indices sometimes have, and that they can provide fertile hunting ground, just domestically without having to go looking at Silicon Valley for really, really smartly run businesses with great growth prospects. And then finally, we just want to highlight the enduring discounts in the investment trust world, which in a way we do cover this in our investment trust report in the course of the year. But such are the discounts still, even after I suppose the improvement in sentiment across the market over the last couple of months, that these are really worth highlighting. And some of the ones we've highlighted have seen very, very strong NAV performance over the past year. And whatever the discounts are, your outlook is when it comes to discounts, what really matters is the NAV, the underlying assets that are within the trust. And eventually that is the thing which should push share prices higher. It's hard for gravity to be defied for indefinitely when discounts yawn to sort of 30-40% and yet NAV is still growing, particularly when it involves liquid assets which can be sold, and a wind up could happen in theory. So yeah, those are the five themes familiar to anyone who read last year's one, but I think there's a definite case for reiterating some of the things which did work last year in our 2024 roundup.
Yeah. As you allude to, last year performance was pretty good. The Ideas of the Year did well in some, and in most cases individually, beating benchmarks. To bring things full circle, the UK Stars, as it was then called, was the best pick of the bunch as well in terms of grouping, I think. So it does show there is a opportunity out there still in the UK market. That does bring us to the end of today's show, though. So thank you very much to Alex, to Mark, to Julian, and to our producer, Maddie Apthorpe. And thank you to you for listening. We'll see you next time on another Companies and Markets show.